Imagine walking into a casino where everyone speaks a secret language. People shout words like bull market, dividends, market cap, and short selling. Money moves in seconds. Fortunes appear and disappear overnight. Yet somehow, a small group of investors consistently walks away richer. But here's the strange part. The stock market was never meant to be a casino. It was originally created as a tool, a system that allowed ordinary people to own pieces of real businesses, a way for companies to grow and for investors to grow with them. Today, however, millions of beginners enter the market without understanding the language that controls it. And when you don't understand the language of money, you usually end up paying for it. So in this video, we're going to decode the most important stock market terms every beginner should understand. But instead of simply listing definitions, we'll uncover why these terms exist, where they came from, and how they shape the financial system today. Because once you understand the language of the market, you stop being the player being played. To truly understand stock market terms, we need to travel back more than 400 years. In the early 1600s, global trade was rapidly expanding. Ships traveled between Europe, Asia, and the Americas, carrying spices, silk, gold, and countless other valuable goods. But these voyages were incredibly expensive and extremely risky. Ships could sink, pirates could attack, and entire expeditions could fail. No single merchant wanted to risk losing everything on one journey. So merchants created a revolutionary financial idea. Instead of one person funding the entire voyage, many investors could contribute small amounts of money and each receive a share of the profits if the voyage succeeded. This concept gave birth to one of the world's first publicly traded companies, the Dutch East India Company. Investors could buy pieces of the company, and those pieces were called stocks. Just like that, the foundation of the modern stock market was born. A stock simply represents ownership in a company. When someone buys a stock, they are purchasing a small portion of a business. If a company is divided into 1 million shares and an investor buys 100 shares, they now own a tiny percentage of that company. This ownership provides two possible benefits. The first is price appreciation, meaning the value of the stock can rise over time if the company grows. The second benefit comes from dividends. Dividends are payments that companies distribute to shareholders from their profits. In the early days of the stock market, dividends were actually the primary reason people invested. Investors weren't chasing quick gains or speculative trades. They were looking for steady income from profitable businesses. Owning stock meant sharing in the success of the company. As stock markets expanded around the world, a new dynamic began to shape investor behavior. Markets started moving in large cycles driven by confidence and fear. This is where the terms bull market and bear market come into play. A bull market refers to a period when stock prices are rising and investor confidence is strong. People believe companies will grow, profits will increase, and the economy will continue expanding. As optimism spreads, more investors enter the market, pushing prices even higher. But markets don't rise forever. Eventually, something changes. Confidence fades, uncertainty grows, and investors begin selling their stocks. When prices decline significantly for a prolonged period, the market enters what is known as a bear market. In a bear market, fear replaces optimism, and investors rush to protect their money, often causing prices to fall even faster. Another important term investors frequently hear is market capitalization, often shortened to market cap. Market cap is simply the total value of a company in the stock market. It is calculated by multiplying the company's stock price by the total number of shares that exist. For example, if a company has 1 billion shares and each share trades at $100, the company's market capitalization would be $100 billion. Market capitalization helps investors understand the relative size of companies. Large-cap companies are massive global businesses with stable operations. Mid-cap companies are medium-sized firms with growth potential. Small-cap companies are smaller businesses that may offer higher growth opportunities, but also carry greater risk. However, it's important to understand that market cap reflects what investors believe a company is worth, not necessarily its true value. Sometimes those beliefs become exaggerated, leading to financial bubbles. During these bubbles and market downturns, another complex concept enters the picture: short selling. Short selling is essentially a strategy where investors bet that a stock's price will fall. Instead of buying a stock and hoping it rises, a short seller borrows shares from a broker and immediately sells them at the current market price. Later, they aim to buy those shares back at a lower price and return them to the broker, keeping the difference as profit. For example, if an investor sells borrowed shares at $100 and later buys them back at $70, they make $30 per share. Short selling is extremely risky. If the stock price rises instead of falling, losses can grow indefinitely because the investor must eventually buy the shares back at whatever price the market demands. In recent years, stock markets have experienced a major transformation. For decades, professional investors such as banks, hedge funds, and institutional managers dominated trading activity. Ordinary individuals had limited access to markets and often relied on financial advisors or brokers to invest. But technology changed everything. Online trading platforms and mobile apps made it possible for anyone with a smartphone to buy stocks instantly. This shift introduced millions of retail investors into the market. As a result, interest in understanding stock market terminology has skyrocketed. Beginners quickly realized that without understanding key investing terms, it's easy to fall into common traps. Many chase trending stocks without understanding the businesses behind them. Others panic and sell during market downturns. Knowledge of market terminology helps investors remain calm and make informed decisions when emotions run high. Today, the global stock market is enormous. The combined value of publicly traded companies around the world exceeds $100 trillion. Despite its size and complexity, the market still follows patterns that have existed for centuries. Periods of rapid growth are often followed by dramatic corrections. Investor optimism can turn into panic almost overnight. Each generation of investors experiences these cycles and learns similar lessons about risk, patience, and financial discipline. Interestingly, data shows that during strong bull markets, search interest for terms like stocks, investing, and market cap rises dramatically. But when markets crash, searches for phrases like bear market, recession, and how to sell stocks increase just as rapidly. These patterns reveal an important truth. The market is not only driven by economic fundamentals, but also by human psychology. Over time, governments and regulators have attempted to stabilize financial markets by introducing various rules and protections. Trading halts, for example, temporarily pause market activity during extreme volatility. Disclosure regulations require companies to publish financial information so investors can make informed decisions. Laws against insider trading aim to prevent individuals with privileged information from unfairly profiting at the expense of others. While these measures improve transparency and reduce certain risks, they cannot eliminate market fluctuations entirely. Markets are ultimately shaped by human behavior, and human behavior is unpredictable. Fear and greed will always influence investment decisions. After understanding the origins and meaning behind these key stock market terms, 3 important lessons emerge for beginners. First, stocks represent ownership in real companies. Investing is not just about trading numbers or chasing trends. It is about participating in businesses that produce goods, services, and value. Second, market terms such as bull markets, bear markets, and market capitalization help describe market conditions, but they do not predict the future. Markets respond to countless forces, including economic growth, technological change, global events, and investor sentiment. Third, the most powerful advantage an investor can have is knowledge combined with patience. Those who understand the language of investing are less likely to make emotional decisions during periods of uncertainty. The stock market has existed for centuries. Empires have risen and collapsed, financial systems have evolved, and entire industries have disappeared. Yet the basic idea behind the market remains remarkably simple: people pooling their money to invest in the future. The difference between those who succeed in the market and those who struggle often comes down to one thing: understanding how the system works. Once you learn the language of stocks, dividends, market cycles, and investor behavior, the market becomes far less mysterious. Instead of reacting to headlines and panic, you begin to see patterns, strategies, and long-term opportunities. If you found this explanation helpful and want to learn more about how money, markets, and financial systems really operate, consider subscribing for more videos like this. If there's a financial concept you've always wanted to be explained in simple terms, share it in the comments. Because the more you understand the system of money and investing, the more confidently you can navigate it.